You struggle with knowing which PD rays will actually hold. And that's normal, because only a small amount of traders actually know this. And today you will become one of them. I and these other students, that you can see here, have been in the exact same position as you. But this, I would argue, changed a lot. We're going to go over 3 steps, where every step is a different PD ray. The first step is a fair value area. The second step, we're going to go over the fair value gap. The third step is swing points. In the first step, fair value areas, that's a gather name for the following PD rays: order block, mitigation block, and breaker block. Now, the usual method on how people find the best order block or the best mitigation block is they see, all right, did it take liquidity? Did it come into a previous PD ray? And I would argue that's a good first step, but it's quite basic. So that's not what we're going to pay attention to today. The first thing for all 3 steps is focus on PD rays that are in the same lag as current price action. So what does that mean? What is a lag again? A bullish lag is from a swing low to a swing high. The swing high in a bullish lag is not that relevant, as in it does not have to be formed just yet. As long as there's a swing low with a fair value gap in it, that creates a lag. So any PD ray, for example, this order block is relevant to us because it's in the most recent lag. That's the same for fair value gaps. So please don't pick out fair value gaps like this one, for example, that doesn't have anything to do with current price action. It's not in the current lag of any price action right there on the time frame that we are looking at. So that already filters out a lot of the low probability PD rays. If they're not in the most recent lag, it's not a relevant PD ray. And again, that differs on the time frame you are looking at. So make sure you start on the higher time frame and then work your way down as well. All right, now that we have that out of the way, the important thing comes. Because PD rays holding is all based on the retracement back into that PD ray. Think of it like this. When the market is going higher, we have someone pushing price higher. When the market wants to then make a retracement to continue higher, or wants to fully go lower, then that will be seen by a push lower. Now, depending on how strong that push is, that will tell us if that PD ray, so the bullish price action, actually wants to hold. The stronger the push lower into, for example, an order block, the less chance that order block has of holding. So what is a strong push higher or what is a strong push lower in the market? Well, if the market is moving aggressively, and it's aggressively moving higher, for example, then what does the market create? Fair value gaps. So the market can't hide its intention. It will always leave behind a clue. And those clues are fair value gaps. That's the true intention of price. So the first step for those fair value areas is we want to recognize the fair value area. So in this case, it's an order block right there. That's the order block. And in this case, it's on the 4-hour time frame. The time frame here is important. Because if on the same time frame we have a potential fair value gap going against us right there into the order block, then that's something we need to know. And before going into the lower time frame, we want to get rid of that potential fair value gap. What does that mean? Well, at this moment in time, we have this bearish expansion phase candle lower, which is the second candle of the 3-candle pattern of a fair value gap. Right? It's always a 3-candle pattern. First candle does not matter. Second candle is always an expansion phase candle, meaning the body is below, in this case, a bearish value gap, below the first candle low right there. Creates the body of the potential fair value gap. So what does the third candle here need to do if we want to avoid this fair value gap from being created? Well, then ideally, we want to see that third candle trading back into that first candle low, because then that shows to us we are not creating that fair value gap. So it takes away that bearish intention. So that is ideally what we want to see first before we go into the lower time frame. Now, if we move to the next candle right there, then what do we see? We see that intention right now has not been taken away. So we have a new bearish fair value gap going into this order block right there. Now, why is this so dangerous? This long wick on the 4-hour candle right there, that could have been an entry confirmation on the lower time frame. But if you only pay attention right here to the lower time frame and you don't pay attention to the 4-hour time frame in this case, then you simply have intention going against your trade ID in the form of that fair value gap. Because if price right now wants to continue lower, where will it continue lower from? Well, there's only one option, and that is this fair value gap sitting right there. So we might have a sting into it, and then we continue lower, losing the trade or hopefully taking a break even right there. But that's not even a trade that we need to take right there. That could have been avoided by simply waiting for that 4-hour fair value gap to be disrespected. Because the first option is that fair value gap not being created, which we can see an example of right here. This order block right there, we trade back into that and we create a potential fair value gap. So on the next candle, that third candle right there, we want to take away that expansion phase. And that will give us a good sign we don't have that bearish intention. And what do we see? We see right there that fair value gap does not get created on the bearish side. That is exactly when we can comfortably go into the lower time frame to confirm it. Then another example right here with this order block that we see, we have a new retracement coming back into that order block. We create a fair value gap right there. So we do not take away that fair value gap. Okay, not the best sign. So if we do manage to create a fair value gap going against us, then we want to see that fair value gap getting disrespected. An easy way to approach this, the highest probability in my opinion, is wait for it to trade back into that fair value gap. Wait for it to ideally fail to create a new bearish fair value gap right there, continuing lower. And then wait for, simply said, a new 4-hour fair value gap right here, continuing higher. So the important thing right here is wait for that extra confirmation. The retracement and how strong the retracement is determines how much confirmation you are going to need. Because think about it, very logical. The stronger the push lower right there, the lower we are also going to trade into a certain order block right there. So the more confirmation you ideally want to not catch the wrong and the fake moves higher, so we can catch the actual right move higher when we actually do want to move higher. Step 1 done. For step 2, we move on to fair value gaps. Because in fair value gaps, it's a total different story. Because this usually can already be seen by the third candle. Now, understanding these fair value gaps will also help you in understanding step 1 and step 3, because they all tie in together. So first, think of that pushing analogy again. We first push higher, creating that expansion phase of a certain fair value gap. Then all of a sudden, the third candle pushes lower very aggressively. For example, here on Australian dollar, US dollar. We have this expansion phase right there. This is the full potential fair value gap. So this is the total area of the fair value gap that can be created. Now the third candle here can do a lot of things, right? Can be a bullish up candle. We can just simply continue higher, creating a breakaway gap, for example. We can also create a consolidation. So a consolidating third candle does not move a lot. But then the third option is it creates a big down candle or a big rejection on the top. So what does that look like? Well, here we see all of a sudden the full area that we had right there, the full gray box, not even half of it is remaining right there, creating, relatively seen to what the potential of that fair value gap was, quite a small area. And that is because the third candle right here is a big rejection at the top right there, pushing all the way lower. So if the third candle of a fair value gap is a very big retracement, leaving behind a very small fair value gap, then this means either one of two things. It is either not going to hold, or it's going to have a deeper retracement into it, so not just a sting into it, to then continue higher off of it. And in both those scenarios, you would want more confirmation, because we know it's most likely not going to be just a sting into it to then simply continue higher. More confirmation when we talk about these third candles of those fair value gaps. A simple way to go about that is off of the daily value gap, just simply require a new 4-hour fair value gap higher right there. So go down one time frame on that fair value gap right there, and then look for a new fair value gap on that time frame below the original fair value gap. So here on your screen is a list with the time frame combinations. We're here on the 4-hour of the daily value gap. We can already see it's not holding and we're pushing lower right there. Another example of those fair value gaps where it's not necessarily the third candle right here, but we do have an aggressive move into it. Then here we can simply use the same premise that we used for those fair value areas, right? So take away the potential fair value gap right there. Trade back into that first candle. Once we trade back into that, perfect. And then you can line that up with the idea as well of a 4-hour fair value gap higher right there, to then potentially continue higher off of that instead. If you are not certain if there's a lot of momentum coming back into that fair value gap with the third candle, then we have a simple saying in the money making team, which is whenever in doubt, wait for a new fair value gap. There's nothing wrong with a little bit of extra confirmation, but there's a whole lot wrong with not requiring enough confirmation. Now we can use the understanding of those fair value gaps in the next step, which is step number 3. Step number 3 is about swing points. When I refer to a swing point, it's a swing high or a swing low. So to understand if a swing high or a swing low is holding, we need to understand what a sweep is. A sweep of liquidity is seen through 2 ways. The first method is through candle signs. Candle signs is essentially paying attention to how a singular candle is forming and what the next candle can do based off of the previous candle. So candle signs is how we can know just purely based on one candle if it's going to be a sweep or not. The way we want to go about that is we want to mark out the swing high on the time frame that we are looking at. So this is a daily swing high right there. So we're going to look at candle signs on the daily time frame. And if we want to look at a sweep on the daily time frame for the daily swing high, then that can be seen through wicks. So these wicks, the both wicks that we see right there, they indicate that we're actually sweeping that swing high when we do return lower. So a fill to close above those swing highs right there indicates that we might have a sweep and that we can actually look to continue lower instead. That is actually already the first method on how you can see a sweep. Now think of what is happening on the lower time frame right there. So time frames below the daily, because that is the second method. The second method is the exact same as candle signs, just seen through different lenses, just seen through different time frames, essentially. So if we want to look at it from the same time frame as the swing high right there, then we use candle signs, the first method. But the second method right there, if we want to go down in time frames, get more confirmation, for example, then this wick, what is that on the lower time frame? Well, that long wick is the following. It is fair value gaps moving higher and fair value gaps moving lower right there, where bullish fair value gaps are getting disrespected because what is the whole video about? Because we have bearish intention right there coming into those bullish fair value gaps. So the intention is bearish. There's a lot of aggressive momentum pushing lower, which is simply seen through a long wick right there and the push lower already. So on the 4-hour, we see the daily swing high right there. We push higher above it with 4-hour fair value gaps. After that, we see bearish 4-hour fair value gaps right there being created. Already tells us all these fair value gaps right there in the most recent leg, they're not very high probability. So we would already want to see more confirmation. But when we then start to respect those fair value gaps and we start to continue lower, creating new fair value gaps, that tells us, hey, I don't think we're in for higher prices. We might want to continue lower actually. Because again, we talked about an order block not holding. We talked about a fair value gap potentially not holding. We talked about a swing high getting swept or actually holding. What does that all tell us? That tells us that we have context in our trading, meaning we have an idea of what it wants to do. If an order block is not likely to hold, well, then we have an advantage over someone else on what the potential direction is of that market price. So here, a lot of people might see this fair value gap right there, but we see that fair value gap does not have a lot of potential of holding. And if it does want to hold, perfect. The retracement is going to be deeper and we might still continue higher off of here. But that will be seen through 4-hour fair value gaps pushing higher. In the meantime, if the 4-hour supports the ID right there, we can actually look at shorts instead. Where potentially when the 4-hour starts holding, we can look at this low right there as a target instead. And see how that lines up right there with as well step 2, the understanding of the fair value gap if it's likely going to hold. And then when we sweep that high and we have the third candle being aggressive, moving lower, it all starts clicking. So in that daily fair value gap right there, if we go into the lower time frame and we even go into the 15-minute time frame, we see we have a few rejections higher right there of the daily fair value gap. Okay, perfect. Afterwards, we start to push lower. Here, we start to create this swing high right there. Then it's all fractal here. Now, why do we not trade this swing low right there, potentially holding to continue higher? The higher time frame premise right now is to continue lower. So always remember that higher time frame rules. Going into the 1 minute, we can do the same thing. Fair value gaps pushing higher, fair value gaps pushing lower right there below the high that we just swept, which is the same thing if we want to confirm that on the 15-minute time frame, because this pattern, fair value gaps pushing higher, fair value gaps pushing lower, is what leads to 15-minute, just a simple wick right there above that swing high. And then eventually pushing lower right there as well. Now, before you go,